You are representative quorum right now.
Good morning. The Finance Committee will come to order. Thank you all for being here. Any, we're not disturbing you, or can we go ahead and do our committee meeting?
You have to be careful. He is your quorum.
I know.
And we have him for 6 months.
They forget, right? Thank you all for being here. Any citizens wishing to address the committee? None. We'll move on to item 3, approval of the minutes from the October 24th meeting. Any questions? So we have a motion by Dr. Weber. We have a second. A second by Mr. Nguyen. All in favor, please say aye. Opposed, motion passes. All right, we will now convene as the Board of Managers to consider item 4A. Mr. Chairman, would you like to manage this process?
Mr. Chairman, thank you very much. Obviously, this was sent out previously. It's been on the portal for y'all's review. If there's any discussion, Robert, is there anything you need to say on this particular issue or whatever? I know this is an annual.
I think the challenge for all of us is making sure that we are always good stewards of the money that's been provided to us by taxpayers. We play such a critical role in mental and behavioral health for this community. So our relationship with MHMR is important to us, our relationship with correctional health. One of the things that we've done when Zelia came on board is we shifted the responsibilities of correctional health to Zelia's responsibility because so much of correctional health is behavioral health. So she deals with a lot of those challenges that we deal with at the jail. So, Mr. Chair, part of this is what we know to be right in the services we provide. Then a little bit of it is just trying to figure out how we work with correctional health and how we work with behavioral health. But if you don't mind, I'd like to turn it over to Zelia and let Zelia make some initial comments and then deal with any questions you all might have.
Thank you and good morning. Good morning. Again, to present to you all a contract between the Sheriff's Department and also with Tarrant County Department of Public Health, a contract to provide services in the amount of $122,200, and that is an increase of over $1 million from last fiscal year. This contract allows for funding for the Department of Public Health for various public health activities throughout the county, and also this pays for the behavioral health services in the county jail provided by MHMR of Tarrant County, which we work closely with in the jail as well.
So can you, it's about 1.1 million more. Do we know where among those 3 or 4 items that the increase occurs?
We do not know exactly where the increase has occurred. Unfortunately, we weren't at the table for this contract.
Okay.
I have a question.
Yes, sir.
If I may. Julia, reading the measure of success, it says improvement of health outcomes in Tarrant County by providing the public health services. And then what I could not find were any type of quality metrics that go with the contract. We're giving them lots of millions of bucks, but there's no accountability to how it's done, that type of thing. That was my question.
Yep. You're correct that they're not in this contract, and but it's certainly something that could be, and I'm quite confident both of these agencies would be open to that because they provide excellent service.
It just seems to me that we ought to have those for multiple millions of bucks.
And Robert, correct me, this has been the standard, give or take the differential in the price or the contractual price. This is not something that is new to the district. This has been an annual contract with the county and with these agencies in prior years.
Yeah, it's a continuation of a
Contract's been here
contract.
for as long as I'm on board 10 years, Chuck, I don't know how long you have, but there's always been this contractual arrangement that we've had with the county.
Zelia, is there a way that, and I know that your relationship with MHMR is very strong, and the relationship that we've had with public health has been very strong. Is there a way that, to Dr. Weber's point, we could work on a metric or something with them that the contract could be provided or amended or dealt with, but yet you as board members could feel confident that you at least knew that there was some type of a process in place where we knew where not only the money was going, but the goals to be accomplished by that?
I'm very confident that that could be accomplished with public health and MHMR. As I said, they're both outstanding agencies and provide quality care, and I know they have their own metrics already as well.
Would it help, Dr. Weber, the point that you raise is what you always raise in quality to the things that we own 100%. Would it be valuable for Finance Committee if Zelia and the team came back and gave updates on where that progress of the money was, or where those increases were, or what the mechanisms were to provide those
Yes, please. That'd be great.
updates on that?
Ms. Fisher, you had a question?
And, go ahead. I was going to say, back to Chuck's question, I think that's a good point, Chuck. As we do those things and we get those periodic updates, it kind of sends the message to these agencies when they come in the future, those need to be part and parcel at that time. So it'd be a good time to get those implemented. I hear they're doing them, they're just not being reviewed and or looked at here.
Okay.
I just wanted to add on the reasoning behind that increase. So during the budget process, we always reach out to the county to get the number so that these amounts are in our approved budget for 2020. So if you look at the size, we've got about $12 million in public health. That was a 3% increase for just inflation. And then the inmates at the Tarrant County Jail, the MHMR contract, we also had an inflationary increase, but there were 5.5 FTEs added to their staffing. So that's the majority of, there's a small inflationary increase, which will be reasonable, but then you also had the addition of 5.5 staff.
Staff that we pay for?
Yeah, well, yes, it's
dollars from
included
the
in that
contract.
3.9 million that effectively passes through Tarrant County Hospital District, but again is managed by the county itself for the inmates.
And I think, Steve, that's what GK is primarily going to say the increase in cost is those additional FTEs they're added in along with the, if he was here, I can't put words in his mouth, but I think that's probably what he's going to say. I think that's one thing. Accountability is the other issue, which is what Chuck was talking about, so.
Is time of the essence on this contract?
I think so, isn't it?
I honestly don't know. I'll refer to staff. Is time of the essence.
Well, I mean, I think the counties started their fiscal year, and so they've, are relying on these dollars as part of their fiscal year.
When we say the county, are we meaning the Commissioners Court? Who is the county? Somebody above us?
Right there.
A level up?
Within, yes, it's
Okay.
within their budget.
And so
It's
these,
within they set the budget.
sorry, that seems really loud. These amounts of money, we weren't at the table, but was discussed on a level above us.
I feel quite sure, correct. As it is done annually.
Way above us.
But they gave us a number of 16.1 for our budget. I'm assuming they gave it to us in August or something.
Yeah,
Ish.
usually in late June is when we start to reach out to them for these numbers.
Okay.
It's a little bit different than what's in the approved budget, but it's very close. From a timing standpoint, I may be speaking out of turn, but this is a contract that we will likely, be paying. Now, if the big question is the quality metrics, then we can work on that after the signing of the contract, or if the board would prefer, we can wait until those are developed to sign that. But historically, for as long as I have been here, we do pay for these services. So I think that would be up to the board.
What's the variance from the budget?
It's just about $100,000. So in the whole scheme of things, it was really close, but it wasn't quite the amount of the final contract. And we did ask for it relatively early, so it was a good estimate.
And Roger, back to your question, it was requested as a joint meeting for that particular reason.
Sure.
I think-
To get it forward,
I
because
think,
otherwise it
yes.
wouldn't.
Because we're not scheduled to meet in December, and they're actually into their years, where I think, correct me, Robert, yeah.
And do we know the reason for the additional 5 FTEs?
Yes, the volumes in the jail have increased significantly since January of 2018 with the new magistrate process the sheriff implemented. So we've also had to adjust our staffing in the jail as well because we are seeing significant volumes compared to prior to January of 18.
I think that would be also part of the metrics to follow through, to see the volume increase and what those policies have actually affected our bottom line on this.
I think that's not only a fair question, but I think the board, in all, that vote on budgets like this, is fair for us to come back and give you an update as we work with the county and ask the county to come back and say, okay, how are these working? What are the outcomes? Because that's the way this organization runs. I know that's the way the county runs, but I think y'all need to have that information in front of you. Okay.
And I have that information, and I can get with Sharon and whomever.
We can get,
I
we can
get
give y'all,
with.
we'll give y'all updates periodically
Give you-
about this particular contract,
Right.
should y'all choose to pass
That's a
this.
good idea.
So what's the will of the board? Do y'all want to approve this
Yeah,
with the
let's approve
caveat
it.
that
Yeah, let's approve it, and
that we
On the matrix.
request that,
Implement those with periodic back to the board.
and that we ask for those metrics and a periodic reporting?
And I think it also is a lesson for us next year, too. If we were given those amounts in August when we did our budget, I know they send us some information, and I know they say, here's what we need, but probably in the future, when we look at the budget, we probably could get really more proactive in asking those questions from August to here than them putting us in this position, right
Yeah,
at the end of the year.
yeah.
So anyway, Sharon, thank you for the update.
We can also try to back that process up a
Sure.
little bit. So we're talking maybe about the projected budget for this contract, because it is so large,
Right.
before the budget approval meeting that we do have, so we can
Good
kind of
point.
have some conversation.
Great.
To do that.
Thank you. All right, so,
Is there any other discussion before I'd call for a motion? I have a motion by Dr. Weber. I have a
DT.
second by Mr. Nguyen. All those in favor say aye.
aye.
No? Thank you very much. Mr. Chairman, thank you very much. I'll turn it back to you in finance.
Thank you both for being here. We
No,
know
thank
you
you.
Thank
appreciate
y'all.
your schedule.
Yeah, I got
So
some
we'll
good stuff.
we'll officially reconvene as Finance Committee. We have a quorum of the Finance Committee, so we'll move on.
Mr. Chairman,
Yes, sir?
I know I've given up back to the finance. Unfortunately, I apologize. I do have to leave like Roger to make another meeting, but I just want to take this opportunity to tell the board that's here and the staff that's here, I wish each and every one of them a happy Thanksgiving. I'll be out of town next week, but hope their families have
Thank you, sir.
have a good Thanksgiving.
Safe
Thank-
travels to you and your
Thank y'all for
family.
everything.
All right, so now we're going to item 5, which is our FY19 year in investment report. And Ms. Clark, do you want to join them at the rostrum? Greg Warner from CTP. What's a CTP? What is a CTP, Vito?
Certified Treasury Professional.
Wow.
It's an official designation. I took a test.
That none of us took.
And
so
I
way to go.
evidently
And he
not.
obviously passed it.
Exactly.
He's got the certification.
Welcome, Greg. Thank you for being here.
Yeah, I'll let Greg introduce himself, but we've had the pleasure of working with First Southwest, now Hilltop Securities, And for about the last 5 years, we were having a conversation about their transition. They had been awarded this contract just before I started. So one of the first things I did was work with Hilltop in getting that converted. So once a year, we have an annual presentation that corresponds with our fiscal year. And this is your opportunity to ask him questions about where the investments are, how the market is going to look. We planned about a 15-minute presentation. And this is related to those quarterly investment reports that we post out on the board portal for you just to glance through. So I'm going to turn it over to Greg.
Okay, thank you. Well, my name's Greg Warner, and I'm a director and senior portfolio manager with Hilltop Securities Asset Management. Hilltop Securities is one of the largest municipal and financial advisory firms in the country. Primarily, their business is focused on assisting public entities with bond issuance and other such needs. My group, we're investment managers. We provide investment advisory services exclusively to public entities. We have about 50 clients on our roster, and all told, we manage around $15 billion. So a lot of clients very similar to yourselves. Safety is our primary objective with all of our clients. And in Texas here, we operate under the auspices of the Public Funds Investment Act, which is state law that governs the types of investments that we're allowed to invest in. And then, of course, also your investment policy, which is adopted by the board. I do want to acknowledge I'm joined here today by Mr. Dan Grant. He's sitting back here in the room hiding. Dan's one of our portfolio managers and has primary responsibility for the hospital's investment portfolio. And while I get to sit up here and take all the glory, Dan's the guy down in the trenches actually doing most of the day-to-day work, so we thank him for that. And I believe we have a presentation. I'm hoping that they're going to pull it up here.
Annotator, but I didn't show you how to use the clicker. So you should be
Scan
able
through.
just to, yeah.
There we go.
To me.
There we go. Well, you're right on it. Perfect. Thank you very much. One thing I would like to say and lead up into this, if there's any questions along the way, please feel free to interrupt me. I don't mind the interruptions and happy to answer questions along the way. Otherwise, I may just put my head down and plow right through it. So please feel free to chime in if
Not a
there's
shy
something
bunch. They'll
that
stop
prompts
you if they
so.
have.
And I recognize that this one's a little small to see, but a couple of highlights here of the portfolio. The market value of the portfolio at the end of the fiscal year 9/30/19 was just about $614 million. And we can see that right in here. That's up a little bit from the prior year. The portfolio a year ago at the same time was $550 million. Most of that increase came in the operating fund, which actually grew by about $64 million. Now, that's not a result of spectacular investment performance. It's more a result of the operating cash flows of the hospital district. The future fund saw a pretty significant increase as well, but the operating portfolio makes up 66% of the grand total and is really the largest portion of the portfolio.
Greg, before you go on, I don't have that slide in the board portal.
That's in the email.
There should have been.
I've got the,
There's probably two different reports. There's an investment report. There should also be a presentation.
Yeah,
okay.
so. that's
Do you
this
know
one.
what DA stands for when dealing with electronic stuff?
That would have been the presentation is the one that I sent this morning.
It's just two
I know.
parts of the alphabet.
They
man.
We call that an ID10T error.
Thank you.
Bigger?
She found it.
Excellent.
Yeah, I'm
Do you want to do
hopeless.
this?
No, you're good. You're good.
You know, the other thing I really want to highlight here, and of course I've got it in great big bold yellow highlights here, is the net income of the portfolio. And that's really the thing that's the most important for the district, because obviously that gets to go to your operating needs and helps assist you with the services that you're providing. But the portfolio earned $16.1 million during the period. And that's a pretty substantial increase from the prior year, actually a 49% increase from $10.8 million a year ago.
Yeah, then we'll just give it to the jail, that's
Way
it.
back to 2017.
We just spent that on
In 2017, the portfolio actually earned $6.8 million. So just in the last 2 years, the income on the portfolio was increased by about $10 million. No, that's really a function of the rising rate environment. Sitting here a few years ago, we were talking about interest rates that were around 0.3%. This year, interest rates are more like 2.3%. So we've seen a dramatic increase in the interest rate environment, and that's directly impacted the portfolio, of course. As I move on to page 2 here, we'll take a look at some of the characteristics of the portfolio. One of the first things I'll highlight is in this gray box here. These are really important figures for us. These are the weighted average. This is the weighted average yield on the portfolio. This is what your portfolio is earning. So a year ago at this time, 1.97% was the average. This year, 2.32%. So the yield on the portfolio has increased by a little over 30 basis points in the last year. Looking at this pie chart over here on the top right, this shows the allocation by various security types. You can see here the biggest item is down in the middle of that, certificates of deposit at 51%. That's up significantly. It was only 28% this time a year ago. Now, we've been working with a handful of banks that had been offering some pretty attractive deposit rates. They had been bidding aggressively for deposits, and we were able to work with staff and take advantage of that. So the flip side to that, of course, is we hold less in U.S. government treasuries and agencies than we typically would. But we're able to capture some additional yield. Just to reassure you, those certificates of deposit are collateralized. They're secured with an FHLB letter of credit. The FHLB is a government agency, and so those are secured deposits. The other large allocation you'll see is 12% in commercial paper. We have a select short list of commercial paper names that we use, and they carry top credit ratings. And then we have almost 30% of the portfolio here noted in LGIP, or actually it's 24% in LGIP and 5% in bank deposits. So roughly 30% of the portfolio. An LGIP is a local government investment pool. It's essentially a money market mutual fund for public entities. So it provides a very safe, liquid, short-term investment option. It's essentially how we manage the day-to-day cash for the district. Down there in the bottom left is the allocation by issuer. The biggest one here is 35% with East West Bank. East West Bank is one of the banks I mentioned offering some really nice CD rates. We also have large allocations at Independent Bank at 11% and Southside Bank at 6%. Again, those are a couple of the banks with CDs that we've been working on. TexPool and TexStar are the two local government investment pools that I mentioned. And then down there at the bottom, JP Morgan Securities is one of the commercial paper names that we use, about 5% there. The remaining 20% is in a handful of different issuers, and none make up more than 5%. And this is one of the tools that we use to make sure that the portfolio is well diversified and not overexposed. We typically wouldn't want to have such a large allocation to one bank at East West Bank there, but it's a very high-quality bank, and as I mentioned earlier, those deposits are secured with letters of credit, so we're comfortable with that. The pie chart in the middle, or excuse me, the bar chart in the middle shows the maturity distribution of the portfolio. It is a fairly short portfolio, especially at this time of year. September is winding towards the end of the operating cycle, and is winding towards the low point in cash for the district. So starting around now and rolling into December, we'll have an influx of property tax dollars, which we'll be able to invest out to next year. But at this point in the operating cycle, the weighted average maturity of the portfolio gets to be fairly short. It's about 130 days at the end of September here. And that's down a little bit from a year ago, but not substantially so. And then over on the right, that last pie chart, the credit quality of the portfolio, obviously very, very high. Collateralized means it's secured in some manner, and all the other investments AAA rated. That A1 plus that you see there is a short-term rating. It's equivalent to a AAA rating. So very high credit quality in the portfolio. Let's clear those lines. So this next slide shows a comparison of the hospital's portfolio to a handful of benchmarks that we compare against. The purple or violet line is the month-ending yield on the portfolio, on the hospital's portfolio. We compare that against a series of treasury indices. So the CMT that you see down there at the bottom stands for Constant Maturity Treasury. So that's an index of U.S. Treasury securities. We look at a number of maturity terms. We have 3-month, 6-month, and 1 month. And the portfolio is comparing very favorably to all of those. One of the things that you can see is through 17 and 18, well, really just through 18, as interest rates were rising, we were having a little trouble keeping up with the pace of those increases last year. But here in 2019, the portfolio has peaked out, and as the other indices have begun to fall, the portfolio's yield is not falling as quickly. So the gap versus those benchmarks is widening a little bit. The 1 year is a longer average maturity than our portfolio, and that explains why we're not comparing against it quite as well as some of the other indices. Yes, sir. Yes, sir. So text pool is one of the local government investment pools, and so we include that as a benchmark here. It's kind of the default alternative option for us. Yes, we do. That's all the comments I have on the portfolio itself. I'm going to move in now and talk a little bit about the economy and about the interest rate environment. And of course, this has been a pretty significant year of changes in the, particularly in the interest rate environment, but the economic background has changed quite a lot as well. I don't want to read through all of these, but of course, you recall when I was sitting here last year, we were talking about the possibility of government shutdown. We did indeed see the government shutdown for 35 days last December. Kind of set 2019 off on a rocky start and caused a contraction, not a contraction, but a very slow period of growth in the economy at the end of last year. And of course, one of the big news events and one of the big factors for financial markets throughout this year has been the trade war, and the escalation of the trade conflict with China has really played a big role in some of the slowdown in the economy, particularly in the manufacturing sector that we've seen. And there's been a lot of back and forth and news on that, but it's certainly a big factor in the market. Employment conditions do remain quite healthy. We're seeing some slowing in economic growth, particularly in the manufacturing sector, but the job market remains quite good. The other thing, of course, is the Federal Reserve completely reversed course. And when I was sitting here a year ago, I was talking about how it was likely we were going to see a rate hike in December and perhaps as many as 3 rate hikes during 2019. And of course, things shifted very quickly, and instead of 3 rate hikes in 2019, we've seen 3 rate cuts in 2019. So I'll talk about that here a little bit more in just a moment. And I guess I'll start talking about it right now. So this is what we call the Treasury yield curve, and this is what it looked like a year ago. And basically, this plots the yield on Treasuries of various maturities. We start there at the left at the 1 month, and we go out to the 10-year, and then eventually to the 30-year. And in a normal sloping yield curve environment, we would see interest rates rise. Now, this is what we consider a very steep yield curve. You can see it slopes upward very sharply. Well, that's an indication that at that time, markets were expecting the economy was doing quite well and would remain quite healthy, and in fact, that we would see interest rates increase. Now I'm going to fast forward and show you what the yield curve looks like today. The yellow line on top is last year's. The green line is today's yield curve. We've seen a dramatic shift. The yellow bars at the bottom of this table show the change in yields over that time frame. And this right here, the 120, that's 120 basis points, or 1.2%. So the 10-year Treasury yield has fallen by over 100 basis points versus a year ago. And the same is really true across almost the entire yield curve. You can see we're essentially down roughly 100 basis points across the entire curve. So a very dramatic shift in the yield curve environment. This is the overnight Fed funds target rate. This is the Federal Reserve's primary policy setting tool. And as you can see, during 17 and 18, we were continually raising interest rates. And again, we've abruptly shifted course here in 2019. And then just to emphasize the point, these are the Treasury yields for the 2-year, the 3-year, the 5-year, the 10-year. We focus a lot of effort around the 2-year because we have a very short portfolio, and so what happens in the 2-year Treasury certainly impacts what we're doing. And as you can see here throughout the last year, rates have continued to decline. There's a fair amount of volatility in there, but we've definitely been on a downward trajectory. And just for fun, this is the exact same chart from last year. So you saw this slide last year, and I was talking about how interest rates had been rising, and we were struggling and dealing with a rapidly rising rate environment. And we went exactly the opposite direction in 2019.
Financial guy's definition of fun is...
Yeah, it's bizarre, isn't it? So what happened, of course, is the big question, and one of the answers is the trade war, but we've seen a global slowing, and particularly in the manufacturing sector. Now, this is the ISM survey. This is a survey of purchasing managers, and there's two of them. One is of manufacturing industries, and the other is service sector or non-manufacturing industries. So the blue line is the manufacturing industry, and you can see after peaking late last summer, it's been definitely on a downward trajectory. Now, we've got this bold line here at 50. 50 is the demarcation line between expansion and contraction. So readings above 50 indicate expansion, below 50 contraction. And so for the last 3 months, we've seen the ISM Manufacturing Index below 50, indicating contraction. The service sector, which is the red line, is quite a bit of volatility. It's still above 50 and holding up better, but clearly it's on a downward trajectory. Now, these are very important because they're very reliable leading indicators for the overall economy and for gross domestic product, which is the primary measure that we use to judge the health of the economy. So these are heading in the wrong direction at the moment, and certainly there's some concern on the manufacturing side with it now in contractionary territory. The next slide is employment. So we'll take just a moment to look at employment conditions. The labor market continues to hold up quite well. In fact, if you look at the bottom there, you'll see the unemployment rate at 3.6% currently, just off of a 50-year low at 3.5%. So this is a market where, for the most part, if you want a job, you can find one. However, we have seen a significant slowing in the pace of job growth. A year ago, the economy was adding an average of 223,000 jobs per month. And excluding the big increase that we have right here in January, if you look at the average since February in 2019, we're adding 151,000 new jobs. So the pace of job growth has definitely slowed. Now, that should be expected. We're late in the expansion cycle. Some slowing in the pace of job growth is reasonable to expect. But this is actually one thing that we believe is restraining economic growth to some extent. And there was a recent survey of small businesses by the National Federation of Independent Businesses. They cited as their #1 problem finding qualified labor. So businesses that are trying to grow and wanting to expand are now having trouble finding folks to hire. Inflation. Inflation's really not a big concern at this point. You can see during 2018 there was a general uptrend in inflation. Helps to explain why the Fed was raising rates during that time. But you can see that we've tempered down and leveled off on the inflation readings this year. Nothing to be too concerned of here. The gray line, which is this bottom line, which is a little hard to see on this chart, is the Fed's preferred measure. It's known as the Core Personal Consumption Expenditures Index. The Fed has a stated target of 2%, and that has been running at around 1.7 to 1.8%, so a little bit shy of target. So that's going to allow the Fed to provide monetary stimulus. That's one of the reasons they've been cutting interest rates this year, is because they don't have to worry about inflation overheating. I don't want to spend too much time here. Retail sales, consumer spending drives the economy. It's certainly been the driver this year as businesses have been retrenching and the manufacturing sector has slowed down. But again, this is one where we're seeing a gradual slowing in the rate of expansion. If you look back last summer, year over year, retail sales were increasing at better than a 6% average annual rate. Today, we're right down around 3%. So growth in retail sales and consumer spending has certainly been reduced. It does include online sales, yes. Now, believe it or not, online sales is actually a relatively small portion of overall retail sales, but it's the fastest growing portion. So online sales is definitely important, but retailers by and large are having some struggles. We also are beginning to believe that some of the recent weakness might be a reflection of tariffs that have begun to impact, particularly in consumer goods. A round of tariffs that went into effect in September applies to consumer goods. There's another round that's scheduled to take effect here in December. There's a lot of debate as to whether or not they're actually going to be implemented, but we do have some concern looking out to next year that the tariffs that are going to start hitting consumer goods is going to have a bigger impact on retail sales. And certainly one of the risk factors that we're looking at.
kicking the can down the road for the last few years, so it's not gonna create more challenge.
There's a lot of anecdotal evidence that consumers are getting stretched. A lot of the increases that we've seen in consumer spending has been fueled by debt. Consumers are borrowing on credit cards. Auto loans, the average term of auto loans has extended to a record, I believe it's right around 72 months now. So, people are having to take out 6-year loans to buy cars. Cars have gotten more expensive. They're stretched a little bit. So loan terms are getting longer. And certainly, we've seen big increases in consumer debt. Now, income has been supporting that, so consumers aren't over-leveraged at this point. But that's certainly something worth keeping an eye on and being mindful of. The housing market, of course, has benefited from a tremendous drop in 30-year fixed-rate mortgages, which you can see there on the top right. Those mortgages, which were over 5% towards the end of last year, can now be had for less than 4%. And we've seen a fairly strong rebound in new home sales, but existing home sales, which make up almost 90% of the market, are still relatively flat. So considering that we have unemployment less than 4% and mortgage rates less than 4%, we haven't seen quite the increase in sales, the housing market that we might expect. And then finally, economic growth. This is as measured by gross domestic product. This is kind of the scorecard. We're seeing a slowing here as well. If you look at the first quarter of 2017 through the third quarter of 18, economic growth averaged 2.9%, just a little bit below the long-term historical average. But more recently, starting with the fourth quarter of last year through the third quarter of this year, growth has slowed down to an average 2% pace. And most recently, the Atlanta Fed has a tracking forecasting measure, and for the fourth quarter of this year, they are currently tracking GDP growth at only 0.3%. Now, we think that's probably on the low side, but there's definitely a risk that we fall below 1% GDP growth here in the fourth quarter of this year. I don't want to spend any time on the market movement here. You guys can follow this slide along here. Equity markets have done pretty well, all things considered. In fact, we hit some record highs last week on optimism that we would get a trade deal. But down there at the bottom table here, you can see the big decline that I talked about earlier in terms of interest rates with yields falling pretty dramatically. And then that takes me to the last slide here on our forecast. Now, this is one of those where, if you tell me what happens with trade, I'll give you our forecast. That's how important the trade issue is to the overall market. Now, equity markets, we believe, are getting a little bit stretched in here. They're obviously trading on a lot of optimism. The other thing that we believe is happening in equity markets is there's a lot of funds chasing yield, chasing positive returns. Interest rates around the globe are still quite low, historically speaking, and in many parts of the world, we're actually looking at negative interest rates. So much of much of Europe, including Germany and Japan, has negative interest rates. And even here in the U.S., you're still talking about 10-year Treasury yields only 1.75%. So there's a lot of money looking for returns, and we believe that's pushing folks into equity markets. So we're a little concerned that if we don't get a trade deal, we could see a bit of a retrenchment in the equity markets. The manufacturing sector is contracting already, maybe in recession. Business investment has been flat, and GDP growth has been supported entirely by consumers. So if consumers can't continue to support things, we could see GDP falter next year. And thus far, consumer spending has held up pretty well, but as I mentioned earlier, we're seeing some declines and some signs of strain beginning to emerge. And of course, I mentioned the tariff issue. That is really a big deal. If we get a significant deal, we think that's probably unlikely. We've already moved away from the idea that we'd get a significant deal, that we're going to get a phase one deal, and we're going to come back and work on more of it later. And even the phase one deal has been called into question most recently by the events in Hong Kong. Congress has just passed what they're calling the Hong Kong Democracy Bill, and China is a little upset about that and threatening, the terms of the trade deal if the president signs that. So there's a lot going on, and that sort of leaves us with a bias towards lower interest rates as we move into 2020. We certainly believe there's a lot of downside risks still out there. So, and that's all I've got.
Thinking about I know the forecast, and it's kind of hard to know, but based on what you think you know and what you think you know, Any advice to us in terms of our policy, change to our investment policy?
We don't need any changes to the investment policy. We have been shifting our strategy a little bit. We're starting to extend our maturities a little bit further than we would probably normally. Quite frankly, the portfolio that we have today is a little bit shorter than we would like it to be. That's not anybody's, well, it's our fault as much as anything, but it's also a function of the operating cycle and the cash flow needs of the district. You know, if we had our druthers, we would have realized in November of last year that that was the peak, and we would have put everything into 5-year treasuries and walked away. We don't always get that benefit.
Does
so,
anybody ever get that?
Nobody
benefit?
does. They
Right.
certainly don't. But it's been a you know, fairly difficult environment. The fact that things shifted so quickly last year, I think, caught a lot of us a little bit flat-footed, perhaps. One of the things that we're trying to be cautious at is I don't want to extend out into 4 or 5-year securities at yields below 2%. By the same token, I don't want to keep everything overnight and just continue to ride interest rates lower and lower and lower. So we've got to find that balance. We believe that it's very prudent to invest in probably the 15 to roughly 30-month area, so a little over a year to about 2.5 years. For us, that's kind of the sweet spot in the yield curve right now. We can lock in yields that are roughly equivalent to what we're earning in overnights today, and that protects us in the event that we do see additional rate cuts next year.
Right.
So
Right.
the Federal Reserve has indicated that they would like to be on hold for some time. We think they probably don't have to cut again until sometime next year. And again, a lot of it's going to depend on what happens with trade and what we see going forward. So the Fed is very much in a play-it-by-ear mode, and to be quite honest, we're a little bit in that mode ourselves. So we're going to focus on your cash flows and your operating needs and, you know, continue to invest to meet those needs. And with the other parts of the portfolio where there's a little more discretion, I expect that we're going to probably look to extend those maturities, and we have been doing that. But it's one of the reasons we move so heavily into CDs. You know, picking up the extra 10 to 25 basis points in CDs has really helped us and really benefited the portfolio. So.
Okay, thank you. Any questions for Greg?
No.
Yes, sir.
How does the election year affect the predictions?
Yeah, this is going to be a really difficult election year from that perspective. Normally, in an election year, you would expect the Fed would want to stand aside and not, you know, have a lot of influence in the rate markets and thus perceive a lot of influence in the election. We're also in an environment where there's been a lot of political pressure on the Fed. The president has made it very clear that he wants a weaker dollar and lower interest rates. And we have a independent Fed that is not supposed to, you know, be pressed by politicians in that regard. But my expectation is that the Fed will have an inclination to stand on the sidelines unless conditions really warrant action. And I think there's essentially zero chance that we'll see rate hikes next year. But if the economy continues to falter and if inflation continues to trend lower, we will see additional rate cuts from the Fed next year.
Let me ask you a different question. You know, a lot of our investment policy is very restricted. Is there any advice for us so that we can type back to change? Because we have, I believe we have to be subject to the county investment policy. Is there anything
Your
that
investment
people needs to look at differently?
No, I don't think so. Your investment activity is really not restrained by the limits of your policy. Your investment activity is somewhat restrained by the limits allowed by law.
Right.
So your policy as it's written allows essentially everything that's allowed by state law.
But
And
is the law adequate to change with the market? That's my matter.
boy, that's a difficult question. By and large, yes. The one thing that most fixed income managers would be able to utilize that we can't here in Texas is investment in corporate obligations, so corporate bonds and notes. We are in Texas restricted to essentially treasuries, agencies, some top-rated commercial paper, certificates of deposit, money market mutual funds, things of that kind. We can't invest in debt issued by Toyota Motor Credit. We can buy their commercial paper, but we can't buy 2 or 3 or 5-year notes from General Electric or Toyota Motor Credit or any other household name. That would be the only area where, you know, I think some folks might like to see, you know, laws loosened up a little bit. But quite frankly, Safety of principle is the primary objective. You're talking about investing taxpayer dollars. You're talking about being stewards of the public trust. And the legislature decided years ago that they didn't want to pass that responsibility down to local investment managers. And you have to keep in mind also, your portfolio is large enough, you're able to hire investment managers and have some professional expertise involved. A lot of other smaller entities aren't. There's many counties across the state that have less than $10 million to invest, and the law is designed to keep those folks from getting into trouble. But you all your restrictions in your policy don't provide any limits upon what we can do that are outside of state law. Your operating cycle does, provide some limits there. Just the fact that you have so much cash that comes into the operating fund during property tax season over the next couple months, and then it gets spent for your operating needs and payroll over the next few months. That provides, that certainly narrows the frame of what we're able to do. But that's just how it works. You're not in a situation that is unique in public entities that we're all dealing with. All your school districts have exactly the same situation. So.
Interesting. Any further questions for Greg? Thank you very much.
Thank
This
you
was
all.
very, very helpful.
Thank you.
Item 6 is our CFO report. Ms. Clark?
I think Greg may have just shown me up on the display monitor
Yeah, he did
here,
actually
so
really much better
that
than
was
you normally
pretty-
do on
yeah,
that.
he had
He
some
didn't have much
arrows going
practice.
there, and
Just a heads up, I've got Mr. Nguyen until 11:15. I think I lose a quorum at that point.
okay, well,
Oh.
it is up to you
Oh, okay,
how
we're good.
quickly these next couple of presentations go, so,
We're good.
um,
Actually, I've been informed that we still have a quorum after.
okay, all right.
We still want you here, though.
One thing I did want to remind you of is we have our external auditors, BKD, that have left the field. They are working on finalizing their audit report, and that is going to be presented to you at next month's Finance Committee, which will be Thursday, December 12th. So Chris Clark, who I think always gives a great presentation, pulls together some interesting comparisons between other hospitals, the Big Five public, and that's always, I think, a welcome presentation there. The next thing in my CFO report is a connection utilization presentation. Now, this was put onto your board portal this morning. So if you want to follow along, I think it's going to show up fine up here, but there is a copy provided to you. And I'm going to ask Dr. Hochberg to come up here, and this is probably the first presentation of many. I expect there to be a lot of questions, a lot of directions about what you would like to see next. And this is one of our first introductions of information that you probably have not seen before. So it will eventually lead up over the next 12 to 18 months as we implement the software system that we've spent a lot of time talking about here at this committee, and that will allow us to look at how we manage the connection population and the health of those members. But today is really just about utilization, how they come into our system, how often they come into our system. I don't know that there was a big light aha moment in any of this, but there's not really a big surprise about how they are coming into our system. So we're going to go through that pretty slowly. I don't know. I don't know if he's still walking or if he's going to come up. So.
Here you go.
Yes. We are.
You want me to stand to?
Yeah, I thought that was a really good invitation to come on up, but.
Sharon, what
Sharon,
point of
wanna-
time are we looking at these numbers from? So what period of time?
So let me get to, and let me, whoops, where's my slide? There should be the connection presentation? Is it all the way through my, I'm looking at the control room. Let me flip through my finance committee slides and see if it is here. It will be a much more difficult, it is on your board portal for sure. There it is, okay. So the utilization by patient type. So we looked at all of the eligible members for connection over our fiscal year, so 12 months, from 10/1 of 18 to 9/30 of 19, and how they accessed our system. If you look at our current enrollment, it is like right at 43,500 for October 31st. But if you look back at 12 months worth of activity, remember, we have about 2,000 that roll on and 2,000 that roll off. We've been building slowly, but there's a lot more members than just the 45,000 that we're talking about as of one point in time. So as I talk through this, this is closer to the behavior of about 65,000 members. The first thing we wanted to do is try to figure out how these members may have come into the system. Are they accessing care? And it turned out that 90% of eligible connection patients actually entered at some point in our system. In this graph, I'm going to kind of walk through the subsequent pages, and it will show you just a little bit of detail on each one of these line items. That was almost 300,000 visits, and each member that accessed care came in about an average of 7.5 times. So it could have been in our outpatient clinics. When I talk about outpatient clinics, that's primary care, specialty care, and urgent care. And then we'll talk about the ED, we'll talk about outpatient surgery, inpatient medical, both medical and behavioral health, the observation where they're actually here in our facility, but not deemed a admitted inpatient, but they are here. And then the other category is a little bit different, but those are the repetitive multi-visits like you have in physical therapy, occupational therapy, some of our cancer center infusions, and behavioral health. So that's what we call series visits, and so that accounts for the other.
Is the attribution table correct from a eligibility standpoint?
Is the what table?
Attribution table, I mean, how they attribute the patient?
What are,
Because I'm looking at 7.7, that's pretty high unless you guys bring them in. It's very effective from a...
well, I think it'll explain it when I go through there from my standpoint. They are accessing primary and specialty care in a strong way, which is where we want them versus the emergency department.
I'm trying to look for, I guess, wrap my mind around, is that a good thing, or is that a good thing that our population?
So these are gonna be, I'll let him speak in just a second, but this again is gonna be utilization. We are not trying to look to see what behaviors might be
Oh, just the
driving
first
this.
cut.
This is gonna,
Okay.
for every statement I make, there's probably gonna be about 8 questions that we're gonna need to drill down over the next 6, 12, 18 months as we further develop managing this population.
Right, so this is just the first cut to ID everything? This one? Okay, I got it.
This is historical behavior.
Yeah, I'll echo that with Sharon. We sat down, we ran through these numbers, high level, just to see first pass, which will enable us then to really begin to drill down onto behaviors, appropriateness of care, who are the individuals that are actually accessing it from a high utilization, from a rising risk, how patients are actually stratified by how they're using the system.
Yeah, and maybe relative to what the what other populations are doing and other health plans, you know, sort of what should those numbers be? Are we above,
That's kind of
below?
the end goal
Got it.
of our look
Got it.
at this pool of population and their behavior, yeah.
Got it.
So I'm gonna kind of go down through each one of these, but this is the summary slide. It brings it all together. Again, as I mentioned to DT, we have 6.9 visits on average for outpatient clinics. We have about 28% of our population that access about an average of 2 times. Outpatient surgery occurs 13%. In 13% of the members, or just over 1 time. Our inpatient and our observation, both for medical and behavioral, if you combine that, that's about 15%. So,
Why do we count inpatient medical?
excuse me?
Why do we count inpatient medical?
So
If-
those would be the visits where either they're accessing through the ED and we deem the care appropriate for admission. That's a big cost of utilization. So I think as we go down the road and we start to try to measure prevention, that will be a big number for us to watch.
If that's the case, how come you don't have inpatient surgery up there?
Because they would be an inpatient medical. They're encompassed in there.
I got you.
We can separate those.
No, I just didn't see it.
That's a global bucket covering
Gotcha.
admission.
Okay,
Now, we did separate out behavioral health because we have separate beds, a separate facility for that type of admission. But inpatient medical includes everyone that has an admitted status.
Where would the outpatient behavioral health be?
So they would be back up here. They would be back up here in the outpatient clinics.
Okay.
And some of them, depending on the type of treatment they're receiving, may be down here in other for a multi-visit type service. So they may be pre-authorized to come for 14 days at one point in time in our intensive outpatient treatment.
Okay.
So it's in one of those 2 buckets.
I think I may be wrong on this one, because I don't know what's the intention for this one, but if it's more toward more population management, you may want to take out, because we have level 1 trauma and emergency places, you may want to take out the disease one.
So separate medical,
Did you find
It's going to
anybody
outlier if they decease, die here, then you take them out so that you can see better trend of
so
people.
DT,
But
from my
it's
standpoint,
debatable.
these would not be the only categories that we look at. But if I broke them out much more, it would just be pages and pages. We have this by patient from a detail standpoint. So again, this is just trying to figure out and communicate from a historical standpoint where patients are accessing care that are eligible for our connection program.
And as we go through the slides, you'll see the top diagnoses for reasons why they presented to the emergency department or were an inpatient. So we're able to drill down into this from utilization standpoint to a very high degree. But this is, again, that first pass through to begin to categorize the directionality of where we want to go.
Okay, if you're ready to look at outpatient utilization, again, 95% of our active members sought care in one of these 3 type services. Our specialty care was heavily accessed about 5 times a year on average. For those who came to primary care, they came about 4 times a year, so once a quarter. Urgent care was about a quarter of the population, and they came between 1 and 2 times on average.
How are you defining active members?
Back to the first slide, these 90% of the eligible members that actually visited in any one of those areas. So if they came to a JPS clinic, hospital, or other facility, that's the 90%.
Is that an enrolled and eligible or equivalent, roughly?
So, yes, that would be the 45,000 members that we have today, but
Enrolled
looking
in
back
connection.
for 12 full
Got it.
months.
Okay.
So I was actually kind of happy to see this. You know, we have anywhere from 2/3 to, 3/4 of our population that do access a primary or specialty care clinic. So the next line item, the next highest utilized area is going to be in urgent care. Urgent care, again, that was somewhere between 1 and 2 times for those that accessed through that. Here's our top 10 diagnostic categories. Upper respiratory and circulatory were the 2 largest, followed closely by digestive systems. And then, these are the bigger ones, but this accounts for about 44% of the urgent care discharged diagnosis. So there is a lot. It's a very broad, after we get past the top 10.
With this number, so are these the included in this number, are these the individuals who came into urgent care and then enrolled into connections, or are these the individuals that were in connection and utilized urgent care?
We do not differentiate this because this is pulled off of the Epic billing data, so we have a diagnosis. So whether or not they came in as already a member, or if we got them eligible during their initial stay, but they have accessed the care over, 1.7 times. So urgent care could have been their first visit, but they're coming back at some point.
I think that'll be important as you're drilling down into behavior, seeing where they're coming in at that point, if the utilization of urgent care, especially when we have other circumstances within how that pipeline is being built with connections.
So in the Arcadia platform, that's gonna pull claims data, right? And so there's a possibility to be able to stratify it if there was a claim attached to them at this stage versus a claim attached to them at a different stage. So we may be able to get to that degree of information that you're looking for.
Well, and I think with our eligibility department, I don't know that Michelle Haynes has presented. She's the director of the function of signing folks up for connection, as well as any other service they may be eligible for, grants, Medicaid, Medicare. I think they will have a better idea of where that intake for the eligibility was. If you're an inpatient here without a defined payer source, you will get a visit from one of our eligibility specialists. We have them in the ED. We have them in some of the higher utilized outpatient clinics. And then, of course, you can make an appointment just to see if you can gain eligibility and then be able to schedule primary and specialty care appointments.
Is it fair to say that if you take these numbers from Epic, you may lose some of the visits that they go to, like a THR or stuff like that, and then you enroll and pull them back? We're still paying for it, right?
So connection patients, as long as if they are connection patients, JPS is the only place of service that we will pay for as a connection patient. So if they got seen at THR, it would be out of network, and we do not pay that unless well, we're very restricted. It is a closed program.
Right, but we do pay them retrospectively, right? If they never been a patient, connection patient, we have people at THR to enroll them and pull them back.
If they are at THR, we work with those outside facilities to see if we can get them eligible, but that stay would not be covered. If they entered as an emergent patient, we do not reimburse that facility out of the connection program.
What might help you, and Sharon, correct me if I'm wrong, but what THR came up to us about 6 years ago, Bill, and asked if we could have embedded into their system somebody that could help direct connection patients back to JPS. It's not a reimbursement. It's just saying if a potential connection patient or a connection patient were to show up at THR or other facilities, we would do our best to put them in the JPS system, but there's not a reimbursement and it's not a pay system.
I guess it's my confusion maybe is if the intention for using this to predict the future risk, then we may, I think we'll get there, but if we don't have stuff that previously the associate, then we lose that information so that we have to go through the whole full cycle before we can see.
Yeah, look, you're correct, right? I mean, obviously, it behooves us to keep the care of the connection population within our four walls, right? Because this is a subsidy program. You know, we don't, they go show up at THR, we don't pay for it, and we're not fully aware of the degree of care, the quality of care, what goes on with those individuals in that environment. And so the goal here isn't just to understand their utilization, but to build all those services around them so we understand where they exist across the continuum of care throughout JPS, throughout their life cycle, so that we're able to truly manage their lives really within our four walls. But you are correct. If they show up and go to a different organization, there is a potential black hole of information for us. And that's why it is absolutely critical that we have those real wraparound services from case management and social work to help navigate them through our system.
Okay. I just want to make sure that, once this thing's rolling out, you're going to drop Aetna, you're going to drop other stuff from a claims perspective, and you will have benefit over 2-3 years previous so that you can reload and predict. Just want to make sure that we don't lose that capability as we have become more and more.
Meaning looking at other payer sources in terms of the populations.
Right.
That's correct, yeah. So we're building into Arcadia claims feeds at launch for connections, our Medicare Advantage programs, and a few others, with the hope and goal that we'll be able to begin to manage all the various populations that we have attributed lives to.
But DT, I think what you're asking is, are we going to download all claims from outside commercial payers into the system? I think we'll only have claims when they are here at JPS. I think that's going to be a difficult partnership to pull claims for all of Aetna, all of Blue Cross. So we
They
can.
should be able to give it to you down the road, because that may come into play when you move into MIPS and all that stuff. Because I think that's where you guys probably will.
Yeah, they've got to be an attributed live to us to be able to ask for that degree of information.
That was one of the reasons why I asked earlier to say, how do you attribute?
So I think we're gonna have a lot more than we have today, but from your vision, that might be a few years out.
Because
Right.
after this one, then you're gonna have to have a whole new category of avoidable ED visit, so that you can see how you're gonna, you can't control them, but at least.
Now, I do know that, and just from a personal standpoint, I do know that now that there are other major facilities up on Epic that, you know, as I log into my chart, they're asking, would you like to merge and pull in data from these other facilities that you've been at? And I click yes, and it takes it like 60 seconds, and it's done. So I know that we are working with other facilities in the area to try to, you know, that started, that conversation about shared data started 10, 15 years ago, and it's just now starting to happen. So the next highest frequency is our emergency outpatient. About 2 times a year, we have 28% of those active members that are coming through the ED. You can see the distribution over here on this side. 89% of these folks are coming 1 to 2 times, and then 96% of them come 4 or less. So we do have some outliers. Those will obviously be being looked at as the medical team gets on board.
And when I look at this bell-shaped curve here, just from the emergency medicine perspective, this is not a surprising bell-shaped curve compared to other populations, right? Because if you want to talk about your high utilizers, which are going to be your 5% or less, that's usually the population that routinely goes to your emergency department on a consistent basis, about 5% of an ED population, give or take. And again, this does not drill down into the specific characteristics of those patients that are using it, what their chronic conditions are, what their behavioral or social issues may be. But the bell-shaped curve on this is not necessarily surprising compared to traditional populations.
So when you look at the top 10, there's a huge overlay, kind of a different order, but 8 of these 10 were the same as the urgent care slide that I showed a couple of slides back. The only 2 that are not on there is the mental delusional behavioral disorders, which we redirect to the ED from urgent care, so that's not a big surprise, and the complications from diabetes as the primary discharge. So you may have a lot of these other symptoms because of diabetes, but if it's not coded a certain way, it is not showing up here. Interestingly enough, these 2 that are not seen in the urgent care as the top 10 are on the top 10 inpatient admissions. So it's all, we've kind of got our list of major diagnostic categories that have come out that we will likely be focused on.
So these, what I'm, a general assumption, these look like all, even with the emergency care, look like preventative types of things, and also just kind of allergies, cold types of things that are normal with populations.
Some might
Some
be,
be-
it's
some
hard to say, right?
Yeah.
You know, if you look at
Could you
acute
repeat
upper
the question?
respiratory infection, so.
Yeah.
I'm sorry, I didn't hear
It
you.
was more that I'm looking at this, and these look like some preventative types of illnesses that are coming in through urgent care or emergency room department that could be helped or utilized with some type of education or primary care. And that's the overall goal of Connections program either way.
Okay.
So that's what we're trying to do.
Correct. And hard to say. I suspect you're absolutely correct. So if I look at circulatory and respiratory, asthma's probably going to fall into that category. And if you've got a well-controlled asthmatic or understanding of these are the indications to go to an emergency department when you have an asthma attack, that may prevent this. But it could also include someone who's got a lot of risk factors for chest pain, and has a legitimate reason why I went there, and then they found out they had reflux disease, right, during their emergency department visit. But I agree with you, a percentage, and probably a very good percentage of this, are things that could be prevented from folks showing up in the emergency department.
And these top 10 represent almost 50% of the discharge diagnosis in the
Is
ED.
your personal view it's too early, so I just want to try to
Personal
understand.
view now.
Personal view. Is this something that it may morph into more of an episodic care down the road so that you can see by episode rather than from the traditional fee-for-service? Because a lot of
Correct.
stuff is built around fee-for-service.
Yes, correct. So this is to build out the episodes of care around the patient population at the patient level itself.
Because I've seen the data, they look pretty standard, so.
Yep.
It's not something that jumps out, which is good. The very first page, the number of access, maybe the group still not familiar with the way that a county hospital with a medical home and the access to different angles, so the visit may be overinflated. But that's just some minor adjustment that may get you there. That's good. I mean, really like it a lot.
Good, thank you.
All right, so going on down the list, the next one was our outpatient surgeries. About 13% of the active members had surgeries just over one time. So I guess a few had two and a few didn't have any, and it averages out to about 1.3 times. And these are our top 5. This is 71% of our connection outpatient encounters. So you can see it's very heavily weighted in gastro, ortho, ophthalmology, oncology, and cardiovascular, which would be our invasive lab. Our medical inpatient, so for those who were actually an inpatient, only about 8% of our members were admitted, about 1.4 times. You can again see how many folks were inpatient. It's a little bit more steep curve than we had on the previous slide, the ED, so. And their average length of stay was just over 5 days, which is right where our overall average is. So here's our top 10 major diagnostic categories for admissions. There was 0 urgent care crossover, and then we had talked about the 2 that were also in the outpatient ED, which was the complication from diabetes and mental health. Now, these medical do not include those that are over in Trinity Springs. If you combine this slide with the one about 2 slides behind, which would be mental health is our #1 admitting factor, and that's on the last page. So if we combine the 2 slides, it would be above here. I struggled with pushing it all together or separating it out, but so that was an interesting impact. There were a couple of other things I did not put on the slide. So just the 62% of these had, on the wrong slide, 62% of these had a surgery during admission. So, Dr. Weber, that's your inpatient surgeries, right? And then 84% of these admissions came through the ED. Now, the ED slide that you saw earlier was only outpatient. It excluded these patients that ended up getting admitted. So these are 2 mutually exclusive slides. Observations, only about 6% of the members had observations, but to the patient, it's relatively transparent. They are an inpatient. This is just the way that they get billed from our perspective. So you can kind of combine those as an inpatient type stay. It's still a head and a bed. Average was just over 20 hours, so just under a day. Our inpatient utilization for behavioral health, this is my last slide. 1% of the active members, or about 528, were admitted. Again, range of encounters, most of our patients just came in for a one-time, average 7-day stay. Interesting to also note, you have to add together the 528 and the 285 that we worked with our partners in the community when we were full. We have outside medical services for the overflow. So we accommodated about 2/3 of the total, and about 1/3 are those outside medical services that we talk about on the income statement that come through our purchase service. So that is an overview of historical utilization for the connection. Probably at least once a quarter, if not every other month, as we gather more information. We'll be starting to bring that to you, I believe, in March. Dr. Hochberg and I will have kind of a rollout from the platform that got approved during our budget process and a timeline for presenting on those patients.
That's great.
But I did want to get you something as quickly as I could after our discussion a couple of months ago.
That's very helpful, very enlightening. Any other questions for Sharon or Dr. Hochberg?
So what will, I know you said March, and we talked about what that would look like in the budgeting, but can you remind me of what is your next data set that you're looking to send through to us?
So what we had promised in March was part of utilization. So this is relatively early. And I also, based on your discussion, it's helpful to know what the board and at what level the board would like to see. So we have chosen the software, and we are working on getting IT development and the connectivity. It will take, and I don't have a timeline right now because that's too preliminary at this point, but we will be presenting the timeline and how that rolls out and when some of this management of the connection population will occur and potential dates that we will have a schedule to see that. At the preliminary point of this, we had planned to present this at the Finance Committee. It meets a little bit more regularly, although it will have some quality implications.
Yeah, it's going to take about 4 to 5 months at minimum to get the Arcadia platform, which is effectively your outcomes, population health platform, integrated into our systems here. Once we have got that integrated, then we can start to pull those reports. What's occurring now in that interim time period, along with being able to do some of this high-level cursory work, is beginning to build sort of the health outcomes team, which cuts across the organization in a multidisciplinary platform to begin to really structure what's the questions we want to ask, what do we want to drive at, what do we want to understand about our patient populations, with a very specific focus around rising risk and, of course, the high utilizers.
Well, in the meantime, can we get somebody from enrollment to come speak to us also?
I'm sorry, someone from what?
For Connections Enrollment.
Oh, yeah, I can have Michelle Haynes come in. December finance is going to be a really busy meeting, but perhaps we can arrange that in January.
I've heard the presentation before, and it's good information to know.
And I think perhaps we can answer your question about how and where these patients are currently enrolled and the source of that enrollment.
Yeah.
Okay.
Michael, for rising risk, are they looking at the ACC scoring, or they're looking at from the ACG standpoint?
So we're basing upon their ACSC, right? So they have chronic care conditions, as well as their number of visits that they've made to points of contact in the organization. So we're using a traditional score to be able to develop that. What we've seen so far is about 3,000, give or take, of our connections are in that rising risk bucket. And the high utilizers, the high complex, high utilizers are around 900.
And I assume down the road, you're going to merge that with financial, so that we
cost accounting will be a feeder into Arcadia.
Because what we probably will be, I'm pretty sure you guys are gonna go down the path, who's the outlier and all that stuff so that we can manage. I'm a firm believer care should be independently. I'm glad you guys going down this path, but
Yep.
no money, no mission. So we gotta have that check on the other side to make sure, because some of this number may change when you start looking at the financial, because MSK is gonna rise right on top of it, but it's not part of the big deal at this point. It's floating toward the bottom, I think, so. And then cost utilization, post-acute care is so key.
That's correct. That's correct. And so again, that speaks to sort of that wraparound type of service that we're trying to build here from a case management, social work perspective, to understand where the connection population is at any point of time in their patient life, which includes helping manage them through any post-acute care services, and at the same time ensuring that it is the correct and appropriate utilization of those services.
From my personal standpoint, I applaud everything you guys do. Love it. I mean, it's additional, a lot more information, a lot more work for you guys, but to get us transition to the new future of JPS. So thank you.
Thank you.
Quick question, last spring, at a meeting in Baltimore, someone gave a presentation on how many patients within the healthcare system seek care outside of their healthcare system, and it was surprisingly a very high number nationally. I just wonder if that's something that that data that we can collect.
For the connection population, I'll give you my off-the-cuff answer. I think it would be very difficult for us to figure out where connection patients may or may not be utilizing, especially if they're outside of Tarrant County, and those that we have started to align EMRs, because we're not paying for those visits. And so we don't know exactly what access points they may be entering into. So it might be one of those things you don't know what you don't know.
Yeah.
And, but we'll work towards to see what data we can pull in, either through other payers or surrounding hospitals.
Thank you all very much. That's great.
Thank you.
Thank you, Dr. Hochberg. Do we clap on your way out?
I thought I was only eye candy. I'm glad I could contribute. Meanwhile, you're peeling off members slowly.
I know.
Yes,
They're dropping like
so
flies.
I'm gonna like
Another one
race
leaving.
through October.
Yes, if you would.
I'm looking at the income statement. It looks different because October is our first month and the month is the same as year-to-date. So we are on to our new budget. The story this month is, it was a great month. We had $4.1 million of operating margin. However, we had budgeted closer to $7 million. And what's causing that is the shortfall up in net revenue. We had a high percentage of our total revenue coming in as self-pay. So it's called an unfavorable payer mix. And it mainly, from the information that we've been able to dig out, it's mainly the folks who came in through the ED. A large number of those get admitted and end up as inpatient. About 80% of our total inpatient comes from ED admissions. And so if you have more self-pay coming to the ED, they end up upstairs. We also have a new surgeon in the interventional area, and the backlog of patients that are getting seen there, as we can accommodate those, are also connection and self-pay. So hopefully we'll not see that large of a number next month, but we'll be monitoring that, obviously. Again, we are on an accrual basis, so we look at how they are registered and what we expect to collect from the services that we are doing right now. We could collect more, we could find more of these patients insurance. So we have a large Medicare and Medicaid pending group that goes around. Michelle Haynes' group that we talked about earlier does not just try to qualify you for connection, but the first round is to actually find a payer source for these patients. So there'll be more to come on that next month. Our expenses were over slightly by $850,000. A large part of that is in salaries, and our health insurance was up by about $700,000 this month. So those are the two reasons there.
What do you expect the dish waiver money to be?
Right now, the dish UC and DISRIP is what's in that line item at 9.8, and we are using the budget until we get further information. Dish comes through twice a year. UC is a little bit more intermittent, and DISRIP, we really work for an end of calendar year measure. So we're just going to accrue budget. We evaluate it at the end of each month, and until I have a reason to expect something different than budget, we'll leave it at that monthly accrual. Okay. But we're not just booking budget. The budget was as good of an estimate as we had at the time, and in December, we may get an indication of where we sit with our first drawdown of dish.
Good.
Okay. Acclaim had a great month. They ended up close to a little over $800,000 ahead of their budget, mainly due to some favorable mix up in their net patient revenue. And that was mainly the types of services that they're providing is a higher yield per unit than like the surgery and the gastroenterology that we look at. So they had a favorable month that helped offset that. And so when you look at the consolidated, you can see here that Greg was doing a better job. You can see here that we ended up at about a $2.6 million compared to a budgeted income of $4.5 for the month. Any questions on financials?
Thank you very much, Sharon. I need a motion to accept the financials as presented by Ms. Clark.
So moved.
A motion by Dr. Weber, second by Ms. Arizola. All in favor, please say aye.
Aye.
Opposed? Motion passes. Move to item B. Mr. Whitman.
Yes, sir.
Bobby Bill.
Good morning. So this is the third amendment to the professional service agreement between the district and Acclaim. Behind tab 2 on mine, I'm not sure where it is on the portal, but this is a request for $1 million, $1.3 million increase, which is budgeted and provides for additional coverage in the ED from a behavioral health perspective, correctional health, and some ENT expansion. This was reviewed and approved by the Claim Executive Committee by email vote and comes to you as a recommendation.
Great. Any questions for Bill on this item?
Recommend approval.
We have a motion for approval. Second. All in favor, please say aye.
Aye.
Opposed? Motion passes. Thank you,
Thanks,
Bill.
sir.
That was tough, wasn't it?
Yeah, well.
Item C, I believe, is being pulled from the agenda. Is that correct, Ms. Clark? Yes. We'll move to item D. Mr. Mendenhall.
Probably should be giving him a hand too.
Yeah, might as well.
No.
No special favors.
You allowed me to come up without a tie, so I don't
exactly
need
right.
applause. I have two contracts for your approval, or for your consideration this morning. The first one is also a sole source, so I want to make sure we put that out there, that when you make a motion, it's going to be for the sole source as well as for the contract. So the first one is for the service agreement for our Sterad sterilizers. We have 6 of them throughout the district. This is a little bit of an increase in what we've been seeing in our previous contracts with them because of the age of the equipment. Our average sterilizer is about 10 to 11 years old right now. And so as those equipment continue to age, they're still within the manufacturer's guaranteed useful life, but just the parts are a little bit more difficult to get a hold of. So that is the first contract that's in front of you.
Any questions for David on this one? entertain a motion. I'm sorry, we need a two-part motion for exemption from the competitive bidding and for the item itself. I'll entertain a motion. Such a motion.
So moved.
Motion by Dr. Weber. Second by Ms. Arizola. All in favor, please say aye.
Thank you. I was just staring them down.
Man, stop it, man. Okay, item E, please.
The second contract is with the incumbent that has been doing our HIM coding system, 3M, for the last several years. 3M is obviously the market leader in this space. There are two things that we're going to be adding to this contract this year. One is the professional side of it, not just the hospital stay coding, but also professional coding. And the second one is a newer program that 3M is putting out called Engage One. And what Engage One is, we have it Immodal, which is our voice-to-text system that we document straight into the record on. 3M bought out Immodal last year, and when they did that, they built an AI interface. So when you're documenting through your voice-to-text, it's going and reading the chart at the same time to then be able to prompt the physician of what should be the next thing that you're talking about. So it's a very cool technology. It's one of the things that I know Dr. Schrader's going, why am I even here anymore?
I know.
You don't even need physicians
I mean,
anymore.
I could do that.
You
right?
can do that, exactly. And that's what we're trying to, we want to see you practicing, Steve, so.
It's not there yet.
Hey, you know,
Yeah.
we got robots for that, though.
Well, and again, a lot of this is because we understand on the backside of it how much time we spend trying to get charts correct. And I know Dr. Schrader and Dr. Ziegler can attest to it. It's tough to get it 100% correct all the time to make sure bills go through and make sure things are appropriately coded. So this is another step in that to prompt a physician to make sure we're doing the right things at the point of care.
Interesting. Yes, sir.
So I'll motion if we can have it piloted in ED first.
Can I deny
That's
that
not my
motion?
call, but-
If Dr. Schrader makes the motion, is there an automatic second from this system?
Absolutely, we'll make that happen.
Any questions for David on this item? I'll entertain a motion. Motion by Dr. Schrader. I guess ED gets it now,
I guess
right?
we'll see what we can do with ED.
Second.
All in favor, please say aye. Opposed? Motion passes. Thank you, David.
Thank you.
Item 8, Mr. Cummings, any report from council?
Good morning, Mr. Chairman. Just very briefly, there were 32 contracts under $500,000 in October of 2019. They've all been posted to your board portal.
Great. Any questions for Scott on any of those items? Okay. We have no items in closed, correct? Therefore, we are adjourned. Thank you, everyone, for your time this morning.